basically money moves markets, Gary, and it's as straightforward as that. What we're looking at is the flow of money through world financial markets, and as those flows peak or trough, that tends to drive a cycle in asset markets. It tends to migrate through different asset classes at certain times, a little bit like thinking of the seasons, spring, summer, autumn. Different asset classes tend to do well. We're kind of about the summer phase now, I would guess, and that's the phase that commodity markets, normally get good traction from.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bone. We have a super important discussion lined up today that I am very excited about. Today, we're fortunate to have with us Michael Howell. Michael founded CrossBorder Capital in 1996. He developed the quantitative liquidity research methodology while he was research director at Salomon Bros in 1986. He was subsequently appointed head of research at Baring Securities in 1992 and was the top-ranked emerging market strategist by institutional investors for the 3 years prior to setting up CrossBorder Capital. Michael has worked in the financial markets since 1981. He's a regular international conference speaker, a qualified U.S. Supervisory Analyst, and has a doctorate in economics. You can learn more about his work on his Substack, which is Capital Wars, and I'm going to put a link up on this video here for you. Michael, thank you so much for joining us today.
Well, Gary, great pleasure to be here. Very, very generous introduction. It sounds a long time ago when I started, so it counts for the gray hairs.
Well deserved. So your research group is focused on monitoring the credit markets, liquidity conditions, and capital flows. Let's start there for our discussion. Michael, why is monitoring global liquidity so important?
I think basically money moves markets, Gary, and it's as straightforward as that. What we're looking at is the flow of money through world financial markets, and as those flows peak or trough, that tends to drive a cycle in asset markets. It tends to migrate through different asset classes at certain times, a little bit like thinking of the seasons, spring, summer, autumn. Different asset classes tend to do well. We're kind of about the summer phase now, I would guess, and that's the phase that commodity markets normally get good traction from.
Interesting. So what are you currently seeing in the U.S. credit markets, the liquidity conditions there, and the capital flows?
Okay, well, I think the first thing to say is that if you look at the liquidity, one's got to take a global view because liquidity is kind of fungible. Just look at foreign capital flows into the U.S. They've been sizable really over the last 10, 15 years, pretty much since the global financial crisis. A lot of money has come into the safe haven of U.S. assets, the attractions of tech, the deep fact, or the fact that U.S. markets are deep and very liquid. That has attracted foreign capital in size. And what you've had against that background is, maybe not surprisingly, strong Wall Street and strong dollar. Long may that continue. There's no sign of those capital flows really ebbing seriously, but it's something that we watch, and clearly we're going to be alert to, because when capital starts to quit, then maybe there's a problem out there.
Well, that makes sense. So it's been stated that a rising tide lifts all boats, but the liquidity tides lift some boats higher than others. How do you determine which boats will rise higher and faster than others in a rising tide environment?
Okay, well, let me try and share a slide to do that. And what I'm going to do is probably to just to run through 2 or 3 slides that hopefully, if you can see that picture, what that's showing, is that clear on your screen?
It is, yes. Yes.
Brilliant. Okay. So what this is showing is the backdrop for world liquidity. It's actually showing the breakdown in a heat map of what world central banks are doing. And the way to read this chart is basically to say that along that north-south axis on the left, what you've got as a list of countries that are about altogether, close to 90 that we're covering. It's the figures are not weighted by size. There's individual, if you like, mosaics or tiles per central bank. And as you move from left to right, what you're seeing is a changing color scheme. And that color scheme basically identifies tightness in red and ease in green. And impressionistically, what you're getting is that the hues in that chart are basically migrating from tight around the middle, or extreme tightness around the middle of 2022, to a period now where we're starting to move more towards the green end of the spectrum, which is saying that central banks are easing. So point number one, we've got some upturn in the global liquidity cycle. And in our view, that began around September, October maybe, of 2022, pretty much coincident with the British gilt crisis. And it was reinforced by the SVB, the Silicon Valley Bank failure in the US around February, March of 23. And what you saw was a very clear inflection in liquidity that I can hopefully demonstrate in terms of looking at, if I can, the next slide. And what this slide here is looking at is our proprietary index of global liquidity. This is shown since 1970. It ranges between 0 and 100 with a 50-unit mean and about a 20-unit standard deviation. The indexes facilitate ease of comparison over time. And what it's basically illustrating is the momentum of money that is flowing through world financial markets. Now, let me stress, this is not money flowing through the real economies. This is the precursor. This is money that is going through world financial markets. It will lead economies, increasingly as that happens, because more and more economies are enthralled to financial markets and wealth effects. And what you can see from the cycles is that those cycles seem to be pretty regular. We've identified a 65-month cycle, or between 5 and 6 years. And the cycle bottomed, as I indicated, in September, October of 2022. It's been picking up since. The latest downdraft, I wouldn't draw too much attention to that. That's largely because of a previous spike and then a downward shift coming out of China. And there is a lot of evidence that China is now embarking on another round of easing. And so we fully expect that cycle to pick up. And it will likely not peak out until late 2025. So we've got, further many months of more benign liquidity conditions. Now, to pinpoint your answer, which is what happens at different phases, we tend to think of, if you like, the seasons of the market being associated with various points around the cycle, and we think of the cycle in 4 different regimes: rebound, which is from the trough to the midpoint; calm, which is from the midpoint to the peak; speculation, which goes from the peak to the midpoint; and then turbulence, when liquidity is below average and falling. And those are the 4 phases, and they tend to line up with different asset class performance and different industry group performance. Now, if you look at the left-hand side of this traffic light system, what it identifies is that rebound, which is the phase we've predominantly been in since September, October of 22, that was a phase that really favoured equities and credits, or should have done, and lo and behold it did, so nothing unusual there. Commodity markets, not really in fashion at that time, and in fact we had quite a lot of commodity weakness, as you recall. Bond duration, not a great area to be in, and as we transition from rebound to calm. Equities keep going, credits kind of get overtaken. They've done a lot of their thing, and performance will start to lag a bit. And commodities really come through strongly through the beginning of the calm phase, and that lasts into the next phase, speculation. Now, we're quite a long way from speculation in our view. We're still maybe in the early foothills of calm, and commodities are definitely running. Bond duration is out of favour again. And then if you look at the industry groups on the right, what it says is that what's really favoured in rebound are cyclical industry groups. What is out of favour are defensives. And then within the cyclicals, you can say that technology is the leader. In rebound, energy doesn't do so well. Financials a bit mixed. But as soon as we get into calm, you're getting kind of 3 green traffic lights. Technology keeps running. Financials, particularly big financials like JPM, should do very well. And energy and commodity stocks start to pick up. So I would venture that's pretty much what we're seeing in the complexion of markets, which comes back to the view we've got, which is, look, hey, this is a very, very normal cycle. And the only difference that I would venture would be that, the Fed and the Treasury are manipulating or mucking around with the bond market. So the bond yield, 10-year Treasury yield, is not really giving a true indicator of a free market price. But everything else is absolutely normal and bang on. And risk assets are going to get further wind behind them and keep running, and that includes commodity markets. So that's the story.
Well, that's interesting, and I love this breakout. So, Michael, how long does each of these periods last? So if we're in the calm and we're near the relative beginning of the calm period and we're a ways away from speculation, how long does the calm period last before we enter the speculation?
Well, what we've got is, as I identified previously in this previous slide, about a 65-month cycle. And, it may be a trite thing to say that they last as long as they do, and it really depends on the speed with which liquidity can change, and it can spike up and we can move very quickly, from a rebound phase into a calm phase. That's possible. So it's all about the level of liquidity and its underlying momentum. So at the moment, we think we're still in the rebound phase, but there is evidence that some markets, some economies, are actually in that calm transition, which is why you're getting evidence that commodity markets are beginning to pick up. And, after all, one's got to accept the fact that markets look forwards and they kind of discount events. And there's been so much attention paid to liquidity in the last 2 or 3 cycles that, a lot of people are actually gravitating this kind of data and maybe anticipating where we're going. So I would suggest that's the picture. My view is we're probably in the early foothills of the calm period, which is why I think that you've still got many, many months, probably lasting well into 2025 for that calm phase. Then we may get a speculation phase of blow-off. And then we've got to think about what could turn the markets down. And I would suggest that maybe there's, some potential tightening by the monetary authorities well after the election. But I think this run up to the election now is actually going to be quite a favourable period. I fully expect the Federal Reserve, and maybe I'm cynical enough to believe that the Federal Reserve will actually put 1, maybe 2 rate cuts in ahead of the election. And, I think that Janet is going to try and put more spending through the economy, which will mean another liquidity boost. So, I think the background's pretty favourable, in short. Yeah,
that should give a little octane to the assets here. So you mentioned blow off top possibly. That kind of is a good lead into the next question. Some were calling for a blow off top in the markets, while others are saying a drop is right around the corner. So it sounds to me like you're more in the camp of a higher probability of a blow off top. But how do you see, so the remainder of 2024 is going to be strong. So is the first half of 2025 where you could see a more speculative environment playing out post?
Yeah, I think that sounds entirely feasible. We won't know until we know. But one's got to put this thing in context, and the dotted line on that chart basically shows the liquidity cycle in context, and therefore our prior is that we would expect, as you rightly say, a speculation phase sometime around about, maybe mid 2025 or so, maybe Q2, something like that.
So what issues do you see the massive deficit spending and the huge debt servicing costs having on the U.S. budget and the Federal Reserve's ability or desire to keep interest rates higher for longer? And if they lower them, what impact will that have on inflation and assets? So in other words, do you see inflation being higher for longer?
I think in short, yes. I think you've got to differentiate, as we do, between what we call monetary inflation and high street inflation. The two things are very different. High street inflation is a hybrid between monetary inflation and cost inflation or cost deflation. So costs and monetary factors come together in the high street to create what people know as the CPI. Cost factors can be things like oil prices. They can be productivity shocks, such as from China. So you get dumping of low-cost goods in the high street. Those are clearly extraneous factors. And then you've got other more mundane or maybe more domestically driven sources of inflation, like what the Federal Reserve is doing in terms of printing money or devaluing the paper dollar. If that goes on, there's another source of inflation. Now, if you take those two factors, I think the cost element is very hard to predict. But our best guess is that probably, given the onshoring and the separation maybe of, or deglobalization, the separation of the US from China with tariffs and whatever, one can't expect to see such gains in terms of lower costs in the next decade or so. So there may well be some positive cost shocks, and we've always got oil prices as a sort of as another bogey to think about at some stage. So costs may well be a positive factor contributing to high street inflation, whereas they were a clear negative factor in the last decade or so. Monetary inflation, on the other hand, is coming through from what the Fed and the Treasury are doing. If you take a look at this chart that I'm putting up now, it's looking at what's happening to US public debt growth. We've never been in this situation before. And as I keep emphasizing, maybe two things. I mean, one is that, as they say in Ireland, if you want to travel to Dublin, don't start from here. And this is the problem that the US authorities, but generally fiscal authorities worldwide, have got. They're starting from a situation where debt GDP ratios are high. In the US, they're probably 110% in terms of public debt to GDP. And you've got higher interest rates. So it means that the interest bill starts to compound. And you can see, maybe on this chart, but certainly on the table, that the size of interest payments start to grow exponentially. Now, that's not really because interest rates go up anymore. It's much more because the debt GDP ratio is higher, always increasing, and that gives you a compounding effect. I mean, just compare what happened or happens today with an interest bill of something like maybe getting on for 2-3% of GDP already. So that's, $1 trillion. With what happened in 1980 when Volcker had interest rates of 15%. Now, the interest bill wasn't significantly bigger as a percent, largely because the debt GDP ratio was very low. And so actually public debt didn't really matter that much in terms of its interest costs. Today it matters hugely. Now, the other thing to say is I'm not hitting on the US here. It just so happens that the US is very transparent with its data, and there are projections available out to 2050 from the Congressional Budget Office. And that's pretty much what we've used. So these are largely consensual figures, but I also would emphasize that they could be a lot worse than this, because the Congressional Budget Office doesn't factor in recessions. It assumes you have a smooth glide path in terms of future growth. And if there's a recession, clearly that will, balloon the deficit out even more. So what this is really saying is that, evidence from the chart on the right, public debt growth is starting to swell significantly. And that's a major factor. Already what we're seeing is the contribution of public debt or the deficit to US credit growth is back to the levels it was at, or the contribution it was making back in the 1940s in a wartime economy. And our line is that this is a war economy again, with the foes being China, albeit with a Cold War, and demographics domestically. Those factors are really pushing up US fiscal spending. So you've got more defense spending, you've got Medicare, Social Security. These are becoming, big items to afford. And the only way governments can really do that is by monetizing debt, which means printing money. Now, they're not going to tell us they're doing that, but believe me, they're beginning to do it. And one of the ways they're engineering that is to actually limit the supply of longer dated coupons to investors. In other words, longer dated bonds like 10-year, 20-year, 30-year bonds, and concentrating issuance in the shorter end of the market through either treasury bills, which have more or less become the plug now for the deficit. So if the deficit cyclically blows out, the treasury will resort to bill finance, and also to shorter dated coupons like 2, 3 or 5-year bond issuance. Now, the reason that that's an important distinction is that credit providers like banks or shadow banks tend to buy shorter dated government debt. That's what they like. Okay, that's their preferred area of the market to buy. If they buy, that is pure monetization. Any purchase of government debt by a credit provider is a monetization. And that's principally what we're getting even now as we speak. It's going on. So it's going to get worse, believe me, and you've got monetary inflation which is being created. Now, the punchline is shown on this chart here, which is basically looking at the black line is illustrating global liquidity over the very long term, going right back to 1975. And you can see how the pool of global liquidity has risen enormously over that time frame. So by 2025, it's going to test $200 trillion. It's currently around 175 or there or thereabouts. The dotted line for reference at the bottom is US CPI inflation, or the CPI index. So you can see that monetary inflation has scaled many times bigger than CPI inflation. And that's because of years of cost deflation thanks to technology, productivity, China effects, etc. Monetary inflation is likely to outstrip, probably in the longer term, cost inflation anyway. But what keeps pace with that, and what do you need to hedge your investments, is gold or crypto. In other words, monetary inflation hedges. Now, gold is a long-standing monetary hedge. It's got 2,000 years of history behind it to establish that point. Crypto is clearly much newer. It's got, barely 2 or 3 years of history. But the evidence that we've got in front of us so far is that Bitcoin at least performs like a monetary inflation hedge. In fact, it proves to be a lot more sensitive than gold and moves earlier. That may change, but for now we've got to look at the evidence, and the evidence tells us it's a good monetary hedge. Gold is a long-standing one. And as global liquidity continues to power up under the forces of monetization by central banks, what you're likely to see is a much higher gold price and a much higher level of Bitcoin. And commodity markets get their cue, or part of their cue generally, from what happens to gold. Gold leads, as you know, and that means that commodity markets are also going to get a period of substantial gains, in our view.
Yeah, so it looks like global liquidity is beginning to go parabolic. You also mentioned the 40s and the 70s there. So it sounds to me like you're expecting quite a period similar to the 40s and 70s of sustained inflation as an environment for all of us.
Yeah, I reckon that's a fair assessment. I think one's got to draw a distinction between the 40s and the 70s and now. We're much more like the 40s, when the driver of monetary inflation was the government sector. This is what happened after World War II. The government clearly was running big deficits and was fueling monetary inflation at the time. There was a so-called Treasury Fed Accord in place until 1951, which basically meant that the long bond was capped, and that was something that actually helped to fuel inflation, monetary inflation, during that period. The 70s were a little bit different. It wasn't really the public sector so much. It was much more the private sector, and that was really coming in the wake of the Nixon shock and the fact that the US dollar came off gold, and you got basically big capital flows. US banks became dominant. The balance sheets ballooned, and there was a lot of private credit creation, and that was really the source of the monetary inflation there. So that's kind of different. But we're much more like the 1940s now.
Okay. Yeah. So, Michael, in your book, Capital Wars, you wrote, as the pool of available liquidity increases, defaults and other systemic risks should diminish, thereby reducing the need to hold safe assets, and so allowing investors to expand their investment horizons towards holding more risk assets. Does this imply that as liquidity decreases, defaults and systemic risks increase, and therefore the need to hold safe assets such as gold increases? And with all the issues surrounding the bond market and the decline in treasuries over the last 3 years, do you expect the investing public will continue to view treasuries the same as they historically have, if and when liquidity decreases?
Well, Gary, that's a great question. There's a somewhat complicated answer to it, but let me try. The first thing to say is that conventional safe assets are government bonds, and that's what we've grown up with for much of the last 3 to 4 decades, and that really embeds itself in the 60-40 asset allocation model, where investors basically run a portfolio of 60% equity, 40% government bonds, and they may tweak that during periods when there's shortages of liquidity or a down cycle. They may up their bond exposure and reduce equities, and similarly Vice versa, when you get more liquidity, you go more into equities, risk assets, and less into fixed income. I think that makes sense. I think so everything you've said about that point is absolutely correct. If you get more liquidity, there's less systemic risk. You want to take risk and you want to go into risk assets. If there's less liquidity, there's going to be more systemic risk and bigger risk of defaults or whatever, and you basically want the safety of government bonds. However, are government bonds in the new world a safe asset? And that's something that one has to contemplate. And one can draw the example of hyperinflations, and you can look back at the German hyperinflation in the early 1920s. And if you held government bonds then, you saw your wealth completely destroyed. Now, I'm not in any way suggesting that the US is going to touch hyperinflation, but you get the direction. We may have a higher level of inflation, and without, with low real yields or whatever, it's maybe not a great place to be investing in conventional governments. TIPS, on the other hand, are not a bad instrument right now. You can get 2.4% real on a TIPS. That's an inflation-adjusted return or inflation-protected return, and I would suggest that it's actually a pretty good thing to look at, simply because it's very, very hard in financial markets to get anything more than about a 2% real return over the long term. So there's a gift out there that people could think about. But leaving that to one side, because that's a bit esoteric, let's think about what could be safe assets in a monetary inflation. And as I said, a safe asset in a monetary inflation is more likely to be gold or potentially something like Bitcoin. It could also be equities, big companies who are able to pass on price increases, maintain their margins, are going to do well in this environment. And you've also got prime real estate, prime residential real estate, well, I should add, which also tends to keep pace during periods of monetary inflation. So draw the distinction between monetary inflation and high street inflation. Think about the devaluation of paper money and think about changing your asset mix away from the traditional 60-40. And maybe in a world that we're seeing, it shouldn't be 60-40. It ought to be 60 maybe equity, and maybe you ought to have 20% in commodities or maybe even a few percentage points in cryptocurrencies as well. So you've got to change your asset mix, and maybe within that portfolio have some cash and some treasury inflation protected securities.
Yeah, so doesn't that kind of paint the picture that monetization is increasing in likelihood because the less that people are going to hold bonds or see them as as being traditionally safe, and they're moving towards these alternative assets, but they're still going to need to issue these bonds for all the debt. So at some point, that's going to increase the likelihood of monetization even further. And the other question I have on that is, how do you view some of the mining companies, especially the gold and silver mining companies, who have access to basically print that safe currency that we're talking about that people are going to be moving into?
Okay, well, look, first point is, spoiler alert, monetization is not coming, it's already here, right? So we got it. And if you doubt what I'm saying, take a look at US money supply data, something like M2, and look at what's driving money supply. It certainly isn't credit growth. It's not private credit growth. It's basically coming out of the government in terms of the fiscal deficit. So that's one of the main sources of what's going on. There's a lot of fiscal spending going on, and bank deposit growth is being fueled by that. And basically what you're seeing is monetization because the credit providers, as I say, are buying bills and short-dated debt to try and match their balance sheets on that. So that's pure monetization is happening. And the fact that gold is going up and Bitcoin is going up is pretty much proof, I would argue, of that feature. And they're going to keep going up because there's more monetization coming. So I think from that regard, you've got it. And you've got to start thinking today, not tomorrow, about how you change asset allocation. What does it mean for commodities in general? Well, let me say up front that I'm not a commodity analyst, and I can't really offer opinions on individual mining companies or maybe even individual commodities. But what I can say is that the commodity complex is generally driven by two things. One is the currency of denomination. So most of these commodities are denominated in US dollars. So one's got to look at the dollar gold price as one of the moving parts in a commodity price. The second thing is to think of some real exchange ratio or multiplicative factor, which you multiply that gold price by to get the commodity, which is something like, for example, the copper to gold ratio or the oil to gold ratio or whatever. Now, those particular ratios, real ratios, exchange ratios, are all about what happens to the world real economy. It depends on the business cycle. It depends on things like China. It depends on things like investment for green energy. All these sorts of things really come into that equation. So I would envision that if you look forward, the gold element, dollar gold price is going up. I mean, that's what this chart is inferring. And you would also, or you could also argue and make a compelling case that maybe the copper gold ratio is going up because of the huge demand out there for copper. If there is a greater electrification, if this AI miracle is true, there's going to be a lot more generating capacity needed. If we've got electric cars, clearly we need a lot more copper, etc., etc. You know the story. Everybody knows that story. Similarly, if you look at something like silver, silver tends to be an industrial metal more so than gold. So if the world economy picks up, you often get an accelerated gain in silver. And the same with other precious metals like platinum or palladium. They tend to be used in, as we know, in car production and have other industrial uses. So generally, I would envision that you've got the whole commodity complex lifting off, and that's one of the reasons we're optimistic.
It's wonderful. So as you've previously mentioned, total global liquidity has historically risen and fallen in these predictable tides of around 5 years. This cycle is determined by the average 5 to 6 year debt maturity profile that you've spoken about. The lows of each cycle nearly always coincide, as you've said, with some kind of financial crisis, and central banks always step in to provide more liquidity at those moments. They simply have to in order to prevent some kind of financial Armageddon. In your analysis, when do you expect to see this predictable tide going out? What degree of financial crisis are you expecting? And what will be the scale of central bank intervention this time around? And before we wrap up here and I ask Michael our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. And when you subscribe, we want to give you a free gift. It's a report that we wrote based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com. Put in your email address to subscribe and receive this free gift on us.